Hello everyone, this is Hena Lakhani and I'm glad you guys are tuning in. In today's conversation, we have with us Mr. Arun Sundaresan, who will talk about how quality companies may help build a more resilient investment portfolio. Welcome sir, we are launching a new NFO, Nippon India Nifty 500 Quality 50 Index Fund. Is this a smart beta fund and what is the core philosophy of the fund?
Thank you, Hena. So this is part of a strategy index, or also called factor indices. Some people also refer to it as smart beta. So what are these smart beta funds? They are a variation on the parent indices. So generally you have market cap based indices which you consider as market, like for example Nifty 500 or Sensex. Now if you take them and do a modification by applying a factor, in this case quality, then it becomes a smart beta or a factor based strategy. So that's what we are talking about. So the core objective of this fund is to identify fundamentally strong companies based on the quality parameter.
Can you define what really is quality in it?
Sure. So in this particular index, quality is defined through three parameters. One is profitability, and profitability very specifically defined as return on equity, ROE. So higher the ROE, higher the profitability, that's preferred. That's number one. The second parameter is debt to equity, leverage, which is lower the debt to equity or lower the leverage, that is better. The third parameter is consistency of earnings. So more specifically, earnings per share, that has to be consistent over the last 6 years. So all three parameters are given equal weight, that is ROE, low debt to equity, as well as the consistency of EPS. All three parameters are given equal weight for all companies except for financial services companies, including banks and NBFCs, where debt to equity is not considered. So therefore only two parameters, 50% weight to each of them. And basis this, the top 50 stocks from among the universe of Nifty 500 are considered to be quality and they get picked up in the portfolio.
What could be some of the long-term advantages of investing in quality companies, especially during uncertain or volatile market conditions?
Quality is a style of investing where the attempt is to identify fundamentally strong companies by looking at three parameters: ROE, lower debt to equity, and consistency of EPS growth. And this can potentially generate returns in the longer term.
Is this fund sector agnostic, market cap agnostic, and how will it help the investors in the long run?
So the fund would pick up 50 stocks from amongst the Nifty 500 universe based on quality parameters, which is ROE, lower debt to equity, as well as consistent EPS growth. Once you have the quality score, it is also multiplied by the square root of the free float market cap of the individual stocks, and that is how you get the weights in the portfolio and the actual portfolio. And this quality portfolio could potentially deliver returns in the longer term.
Who could be the right investor for this fund, and can investing via the index fund route be beneficial for the investor?
So this fund is an equity fund at the end of the day. Therefore, it carries all the risk and return of any equity product in general. Within that, this follows a particular style, which is quality. And given whatever we have explained, the fund may potentially generate returns in the longer term. And coming to you in the index format, it is likely to be true to label, and it will always have quality as the basis for picking stocks.
Thank you, sir. For more details, please refer to the link below.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.